Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, I was scrolling through the comments section and I was driving home. I was thinking about something. Someone wrote, I think it was a comment yesterday or something like that, that their return from the channel was like 50 something percent. My return, I think, is like 160 something percent over the past year. And before this pullback, it was 315 or 16%, depending on where you are and where the starting and end point is. And I overweighted oil quite heavily in the beginning. And I was trying to think of how can I describe why I was buying some of these companies and why I overweighted some versus others. And I think I know why I did it. And I'm here to explain kind of how that I did all this. And here's the explanation. So I overweighted SM Energy, Centennial Development Resources, QEP, Contango Oil and Gas, Tellurian, Grand Tierra Energy. There was a bunch. All right, very heavily weighted in oil and natural gas, Crew Energy, Athabasca Oil. There was a bunch. Birch Cliff Energy, but it was very oil and natural gas heavy. I knew that the ratios had the largest expansion possibility, or compression, if you want to say it. It could compress down against gold, which gave it the most opportunity. Which means that the risk reward was one of the best that I've ever seen of any investment. Uranium also has that risk reward. But I think that the oil companies at that time have better risk reward profiles than uranium companies did. And what I ended up doing was overweighting a lot of the oil companies based off of a few things. And I showed you a clip on how I select companies based off of, we'll call it fractals. You could say fib extension lines. There's some things that you could refer to, but basically it's how much bounce the company has from a technical perspective. But when looking at it and evaluating the different sectors, the reason I overweighted oil is because you have basically a vertically integrated company where you can go from, and it's not fully integrated, but you can go from exploration to developing to producing. Now, they may not refine it. That's the next step. And that's what these large corporations do, is they go from exploration to end customer, and it's vertically integrated the entire way. But what a company can do is, if they took on too much debt during the quote good times and the bad times came, it pushed these companies all the way down into the dirt because of their debt and because of perhaps their break-even points to make money. It's where they are in their cost curves and how low the price of oil fell. So some of them could have went bankrupt, but they were producing. A lot of them were producing, and they're developing, and they were exploring. So it's got a lower risk because you've got money coming in from oil being sold, which funds the development of other areas and also funds the exploration of other areas. So if you look at the potential risk, you can buy some of these companies that maybe took on too much debt. The debt would be inflated away through the price of oil, because oil is one of the most inflation sensitive commodities out there. And I know that. It's also the number one commodity. So I overweighted oil and a lot of those companies based off of the potential returns, the risk reward, the company's profile of being more vertically integrated, where they can explore, develop, and produce all in one company, versus other sectors where they may be more of an exploration company and have no money coming in, or others that are just developing. They're not exploring. They're mainly just developing, and maybe some are exploring and developing, something like a Goviax or a Deep Yellow or something like that. But most of them are not producing, so they don't have the cash flows coming in. So I view that as riskier bets. So I didn't put as much money into the uranium sector, especially not into any individual one company, based off of them not being able to grow their cash flows as easily as, say, some of the oil companies. So I really loaded into the oil companies, and I took larger positions in single companies versus some of the uranium sector. So my approach was that approach. It was based off of the ability of the oil companies to produce oil, grow their production, and explore and find more. And those are the three. So I ended up with a lot of small, they were mid cap companies that turned into small caps from the bear market. And I bought in at like 150 million market cap. And I was in disbelief that some of these companies could have billions in cash flow with a B towards the middle of this bull run. And I could buy the company at $183 million with market cap, which means that you could potentially have estimated market caps of 10, 20, 30 billion with a B, depending on what the price of oil was or is, and what they could grow their reserves and produce. So I chose oil in that sector and some of those companies because of those multiple reasons. I don't think you can do that with any other sector. Copper companies, usually they have gigantic mines. It takes a bunch of money to get moving, and you won't have that explosive growth like you can with the ability to grow and expand an oil company. So I think it's inherent in it's inherent to the business model. Uranium's a little bit different because you got to have these big mines. You got to develop these mines. They take a long time. They take permits. They take all this stuff, and it's a little bit more of a barrier to entry. But on the other hand, if you're in a developer that's very close to that stage of developing a mine that could go into production, the value could ramp quite dramatically. So those are the companies that I chose in the uranium sector that I overweighted. It was the ones that I thought were best positioned to potentially produce in the next bull market that were 3 to 5 years, something on the lines of that, out, or management teams that have set up these things before, that know the process to speed that process up and position the company in a way where they could take advantage of the next bull market. So something like a Deep Yellow or an Encore Energy or something like that, I think would be in a good position with a good management team. So I overweighted those companies. I overweighted the oil producers that were beat down the most, that I didn't think were going to go bankrupt, that had the bounce, the CDEVs and the SM Energies and stuff like that. And again, guys, there's other ones that I chose that didn't go up as much, and they may be lagging behind it, and they may catch up later. It's really, really hard. This is where the magic is and the special sauce is. All I can say is they had traits that were all very similar, and some of them really took off. Others, they lagged behind a little bit. Others had new management come in and changed the dynamics of the company a little bit. So that's how I chose it. And some of these royalty companies, I went into some newer royalty companies that have a lot of potential growth, and I spread money out across, and then I put more money in some of the larger ones. Now, my returns that were really good, I'm cherry picking them. I am. They're in my energy weighted portfolios versus my precious metals ones and diversified mining ones, which is lower and is very much closer to the 50% mark than it is my other ones that went crazy. But I mean, just looking at this and trying to give some sort of guidance on how to choose companies where you've got this macro thesis that works, you have to convert it into vehicles that work and that push you forward. The companies that I would be avoiding and I would not overweight are a lot of the exploration companies, especially in like gold and silver, where there's like a billion of them. I don't have any sort of advantage there. I don't know. I don't have boots on the ground. I don't have anybody like a geologist that I have hired, that I'm talking to the companies, myself. I'm in a couple companies I talk to, but not I don't go there and talk to a whole bunch. So some of these guys, if you're going to do that, what I would do is I would follow someone like Eric Sprott, because he's passionate about this stuff. He goes and talks to these CEOs and the geologists. He probably has geologists that he has hired for himself. He has all this resources at his fingertips. So I'd probably just follow what he does, and that's how I chose some of the companies that I own, that I put some money in and spread across in the exploration companies for gold and silver. And then I figured that there's just not that many exploration companies in uranium, so I spread my money across those as well. And I really only have one exploration company in oil, which is Reconnaissance Energy Africa. And I'm not trying to sell this, guys, but that's the only one I have there, just because if they hit, they could have the mother lode there, and if they hit the mother lode, then their stock goes through the roof. So I'm going after what I think is a large find, and it's light sweet crude. So I'm really going after the ones that have the greatest potential upside in them. Everything else, I don't need to go into it, because if you can structure the portfolio correctly and you hit a few of these, the returns could be so massive that those few that you do hit pull the entire portfolio so far forward that it drags your returns higher than everyone else, versus someone who doesn't do any risk at all. And knowing when to kind of put your money in and doing the full risk button, or the full send, so to speak. It does take some experience. It does take some thought. And I think that's kind of where the value of this channel lies, is getting people prepared for the macro thesis, getting their minds right, getting their paradigm right, and then being able to hold on, and then selecting companies is the second part to being a very good investor. And then the technical analysis is the timing to know and verify that you're right. So it's trying to tie everything together and be an all around good, solid investor to get returns that most people can never think of, and you can get them in single years. Now, I'm not saying that every year is going to be like this. It's not, but we're going to get some crazy years ahead of us, and you're going to have to be very seasoned just to hold on. You're going to have to not just know the macro, because what's going to happen is you can start out with accounts of $5, $6, $7, $10,000, and by the end of this bull market, if you've picked right and you bought early enough, and let's say you 10x your entire portfolio, 10 grand goes to $100,000. And if you have even more money than that, some of your up and down days will be $100,000. And it takes a level of maturity to mature that fast, to accept the gains and to hold on to those gains. So someone who is used to $400 or $500 swings, it's a whole different ball game, just mentally and physically, to be seeing $50,000, $60,000 daily swings, or $100,000, $200,000 daily swings. And you have to progress forward quite quickly if those gains come quickly. So you kind of have to really be disconnected from the money that's in there, and more connected with the logic and the thesis and your buy and sell points, and how to value assets. Because, I mean, that's the whole name of this game. It's knowing that things move in cycles. It's investing in things when they're down because the money's not there. It's knowing that money's rotating from sector to sector. It's knowing how to value assets. I use ratios. And the most important thing, if you're not doing this in the stock market, is how to value things in life, because that really is what sets up a good buy point versus a bad buy point, or a healthy person versus an unhealthy person, or whatever it is. So I was just thinking on the ride home, kind of, why maybe some of my portfolio gains might be different than someone else. And it's got to be due to company selection, position sizing. And the way that I chose that in the beginning of this market is I overweighted a lot of of some of these oil companies that worked out very well. And I overweighted, I think, were very good uranium companies as well. And I did it based off of a whole array of different things that you guys seen in some of my different, other clips. So that's what I wanted to touch on in this clip. If you guys like this type of analysis, give me a thumbs up. Subscribe to the channel if you haven't. Please share this stuff if you guys are wanting to help the channel, and if you don't donate or anything like that, but at least share it with people on Twitter or your friends or your family. Share the videos, help grow the channel. That's what I ask, really. And if you can do that, thank you for doing that. Thanks for listening. This is Finding Value.